Investors betting against Bitcoin miners are engaging in short selling, which involves borrowing shares of a company, selling them at the current price, and hoping to buy them back later at a lower price. Here's how and why this happens with Bitcoin miners. 1. Why are investors shorting Bitcoin miners? A. Rising operating costs. Mining Bitcoin is energy intensive, and electricity costs have been increasing globally. If miners can't control these costs, their profit margins shrink, even as Bitcoin's price rises. Investors may believe these costs will eat into the miners' profitability, making their stocks overvalued. B. Competition and hash rate wars. The Bitcoin mining space is crowded. New players entering the market increase the global hash rate, the total computational power used to mine Bitcoin. As the hash rate rises, mining rewards are distributed among more participants, reducing individual company profitability. C. Over-leveraging concerns. Many Bitcoin miners, like Marathon Digital, MARA, have taken on significant debt to fund expansion, for example, buying mining equipment. Investors may worry about their ability to service this debt, especially if Bitcoin's price doesn't stay high. Stock valuations may be too high. Mining stocks often trade at high valuations because they're seen as leveraged bets on Bitcoin. When Bitcoin prices rise, their stocks should surge even more, but sometimes these expectations are already priced in. If investors believe the stock is overvalued relative to its actual mining performance, they might short it. E. Regulatory and environmental risks. Governments are cracking down on energy consumption and emissions, especially for Bitcoin miners. Investors betting on stricter regulations could short mining stocks, anticipating future struggles. 2. How does short selling affect stock prices? When a stock is heavily shorted, there's consistent selling pressure, which prevents the price from rising, even if Bitcoin is booming. If there's no major new buying interest in the stock, this shorting activity can create a downward spiral, further discouraging other investors. 3. Examples: MARA and Riot platforms. Companies like MARA and Riot platforms, Riot, often see high short interest because their financials rely heavily on Bitcoin's price staying high or rising. They have significant operational costs, making them vulnerable to market downturns. 4. Short interest and market sentiment. If Bitcoin miners are heavily shorted, it signals that some investors don't trust the company's ability to translate Bitcoin's price surge into profits. For instance, miners who use convertible bonds or sell Bitcoin to fund operations are seen as less resilient compared to companies like MicroStrategy, which just holds Bitcoin. 5. What could change this? A short squeeze. If Bitcoin miners report strong earnings or Bitcoin prices rise even further, short sellers might be forced to buy back shares to close their positions, causing stock prices to surge. A drop in operational costs or a breakthrough in mining efficiency could also attract new buyers and drive prices higher. In summary, investors short Bitcoin miners because they see risks in high operating costs, regulatory pressures, overvalued stocks, and heavy competition. These bets create selling pressure, which suppresses share prices even when Bitcoin hits record highs.